A credit score can feel like a mysterious number. It can also feel like a very powerful one. A person smiling while looking at their credit score on a smartphone, with a number above 700 visible. When that number climbs above 700, it genuinely changes your financial life for the better. A 700+ credit score opens doors that were previously closed. You find yourself eligible for better interest rates on mortgages. You find yourself eligible for better interest rates on car loans. You find yourself eligible for better interest rates on credit cards. This means you can save a significant amount of money over the long term. This essay is the 6th and final step in our series. It provides a clear, actionable plan to help you reach that coveted 700+ score. We will provide you with a detailed and straightforward timeline to follow. The first 30 days of your credit improvement journey are about taking immediate, high-impact actions. Your very first move on day 1 is to get a complete picture of your credit situation. You need to obtain your credit reports from Equifax, Experian, TransUnion. You are entitled to a free report from each bureau annually. At the same time, get your current credit score. Once you have these documents, sit down and create a simple list of all your debts. Include the total balance. Include the creditor for each account. This initial assessment is your baseline, the starting point to measure future progress. During the first week, day 2 to day 7, your primary focus should be on accuracy. Carefully review every single line item on your credit reports. Look for any information that seems incorrect. A late payment you know you made on time, an account balance that is wrong, an account that does not belong to you at all. If you find any errors, you must dispute them immediately. The credit bureaus have online forms and processes to make this easier. Be sure to provide any documentation you have that supports your claim. Fixing errors can be one of the fastest ways to improve your score. In the following 2 weeks, day 8 to day 21, the focus shifts to your credit card balances and payment history. Begin by paying down the balances on your credit cards. As you enter the second month of your plan, from day 31 to day 60, your goal is to build upon the good habits you started. Consistency is the key to lasting credit improvement. Continue making all of your payments on time without fail. Keep a close eye on your credit card balances to ensure they remain low. Do not let them creep back up after you have worked so hard to pay them down. Take a few minutes each week to review your bank and credit card statements online. This helps you stay aware of your spending, track your progress, and catch any potential issues, like fraudulent charges, before they become bigger problems. Around day 41 to day 50, consider a strategic move. If you have a credit card you've managed well for a while, a solid history of on-time payments, consider calling the issuer and requesting a credit limit increase. A higher credit limit can immediately lower your overall utilization ratio. For example, a $300 balance on a $1,000 limit card is 30% utilization. If your limit is increased to $2,000, that same $300 balance is now only 15% utilization. This can give your score a nice boost without you having to pay down more debt. In the final part of this 60-day period from day 51 to day 60, take a moment to evaluate your credit mix. As you move into the final phase, day 61 to day 90, focus, review focus, maintenance focus, long-term planning. Start with a thorough review of your progress. Pull your credit score again, compare it to where you started. Check your credit card balances, are they still decreasing? Have you avoided late payments? This review shows what's working and lets you adjust your budget or your debt repayment plan. Days 76-85. Watch out for a common mistake. If you paid off a card, do not close it, especially older cards. Your length of credit history matters. Closing old accounts shortens your average account age. It also lowers total available credit and can raise utilization. Instead, keep the account open, use it for a small recurring purchase and pay it off each month. Section 5. Understanding your credit mix. One factor that affects your credit score, it is called credit mix. Different types of credit accounts you have, lenders want to see you can handle multiple kinds of debt. Variety shows you are a versatile, experienced borrower. You do not need many accounts. Balance between two main categories matters more. This signals financial maturity and can boost your score over time. First type, revolving credit. Borrow, repay, borrow again. That is revolving credit. Common example. Krediten, stock credit card. Set credit limit. Choose how much to use each month. Your payment can change with your balance. 1 or 2 well-managed cards build strong history. Shows you can handle flexible credit without overspending. Second type. Insau. Are you coward than sauber? Installment loans, borrow a fixed amount, repay in equal payments over time. Applying for new credit can be both helpful and harmful depending on the timing and your overall credit health. Every time you apply for a new loan or credit card, the lender performs a hard inquiry on your credit report. This hard inquiry can cause a small, temporary drop in your credit score, usually by just a few points. While this dip is normal and your score will likely recover within a few months, having too many hard inquiries in a short period can make you look like a risky borrower. Therefore, it is important to be strategic about when you choose to apply for new credit. There are clear rules of thumb to follow. First and foremost, you should not apply for any new credit if you are currently struggling with late payments or high credit card balances. Your priority should be to fix those fundamental issues first. A good general rule is to wait at least 3 to 6 months after opening one new credit account before you apply for another one. This gives your score time to recover from the inquiry and allows you to establish a positive payment history on the new account. There is an important exception to the rule about multiple inquiries. Multiple inquiries for the same type of loan are typically treated as a single inquiry within a 14 to 45-day window. It is essential to have realistic expectations about how quickly your credit score will change. Every person's credit file is unique, and the speed depends on your starting point. Some actions can produce results relatively fast. If you dispute an error on your report and get it removed, you might see a big increase in 30 to 45 days. Paying down a card from roughly 90% utilization to under 30% often boosts your score within 1 or 2 billing cycles. But many important factors take more time. Building a long history of on-time payments cannot be rushed, year after year. One on-time payment helps a little. Dozens of them add up to a huge effect. Expect clear, steady improvement over 3 to 6 months if you follow the plan. If you start very low or have big negatives, a 100+ point gain may take 6 to 12 months or longer. As you work to build a better credit score, keeping a few key tips and warnings in mind can help you stay on track and avoid common pitfalls. The single most important rule is to pay every bill on time, every single time. Your payment history is the largest component of your credit score, and even one late payment can cause significant damage. Set up automatic payments for at least the minimum amount due on all of your accounts to ensure you are never late. This simple habit is the bedrock of a strong credit profile and cannot be overemphasized. Next, focus intensely on your credit utilization ratio. This is the amount of revolving credit you are using compared to your total credit limits. Always aim to keep your overall utilization rate below 30%. For the fastest score growth, strive to keep it below 10%. Also, remember to keep your old, paid-off accounts open. The length of your credit history matters. Be very cautious about applying for new credit. Avoid many new accounts in a short time, as multiple hard inquiries can lower your score. By following this comprehensive guide, you have moved from understanding the basics to implementing a concrete step-by-step plan. We have covered the immediate actions for the first 30 days, the habit-building strategies for the next 60 days, and the long-term maintenance required in the 90-day plan. You now have a clear checklist to guide you toward a 700+ credit score. This includes checking your reports, fixing errors, paying bills on time, lowering card balances, and strategically managing your credit mix. A clear plan is your most powerful tool. If you followed all 6 steps, you now have a full credit repair blueprint.